Welcome back to the channel. Today we're talking about Indian Oil Corporation, or IOC, one of India's most consistent dividend stocks and a PSU giant trusted by millions of investors. Let's start with a quick overview. IOC is the largest government-owned oil refining and fuel marketing company in the country. With a diverse presence spanning refining, pipelines, and marketing, this company sits at the very core of India's energy needs. The stock is currently trading around the 140 mark, which is much closer to its 52-week low of about 110 than its recent highs near 180. That means it's in an attractive value zone for long-term investors who want dividend income with government-backed safety. Now, let's look at the most recent financials. In the first quarter of fiscal year 2026, IOC posted a strong net profit of over 6,800 crores, almost double compared to the same quarter last year. Revenue grew to over 2.2 lakh crores, with profit margins benefiting from both lower raw material costs and better operating efficiencies. Essentially, IOC delivered a solid set of numbers thanks to its scale and focus on operational discipline, even when oil prices and refined margins were somewhat volatile. One of the standout features of IOC is its sheer dominance in the Indian market. The company operates the country's largest refining network and the most widespread distribution infrastructure, including fuel stations, LPG distribution, and industrial supply chains. This powerful footprint, along with deep government backing, helps IOC weather rough economic times and sectoral cycles much more smoothly than most private competitors. Now the big one, dividends. IOC has been a favorite for income-focused investors for years, and with good reason. The company's dividend yield regularly sits between 7 and 9%, making it among the highest in the large-cap universe. In the last 12 months alone, IOC paid out dividends of 3 per share in August, 7 per share in July, and 5 per share in November, just to name a few. Annual payouts routinely exceed 9 to 16 per share, with payout ratios often hovering between 40 and 50% of profits. This level of consistent, generous distribution is rare, even among PSUs. Let's talk about timing your entries and exits for both short and long-term investing. For short-term traders, IOC becomes really interesting when the price dips near its 52-week low, say, between 110 and 125. This is often when dividend yields shoot up, making the risk-reward equation especially attractive. For exits, you might look to take profits as the stock approaches recent highs in the 170 to 180 range, or when there's a strong rally across PSU stocks in general. For long-term investors, gradual accumulation below 140 is a solid strategy. By buying in value zones, you're positioning for high passive dividends, stability, and potential long-term appreciation as energy demand in India continues to grow. It's a classic defensive play. Reliable payouts, government security, and robust business fundamentals. Of course, every investment has its risks. For IOC, the main ones are fluctuations in global crude prices, possible policy changes, and the broader PSU sentiment. However, its strong asset base, market dominance, and reliable government support help cushion these risks, especially for dividend seekers. So, what are the takeaways? IOC is a genuine dividend powerhouse, one of the rare Indian stocks offering both high, regular yields and safety. Whether you're investing for short-term trades or building a passive income portfolio for the long haul, IOC deserves your attention, particularly when the price is close to its historic support zones. Disclaimer: this analysis is for educational purposes only and not investment advice. Please